Hello, this is Dean Gonzalez of Heartwood Financial Services. Thank you so much for tuning in to the Heartwood Monthly Review. We're going to be going over January and all the exciting stuff that happened, how we started off with a bang and then things kind of fizzled out at the end. Also giving you an outlook of what's to come. So stay tuned. We have a great presentation in store, and as always, after the disclaimer slide at the end, if you hang around, you'll get a little bit more of the detailed slides as well. Thanks. As always, I like to start with the asset class reviews. As you can see here, the S&P 500, the large cap stocks, finished flat for the month of January. No surprise based on some of the news that we got from the coronavirus. We'll talk more about that. Small caps ended up in the hole, as well as international stocks, the developed and emerging markets. But we did have a good performance from real estate and from the bond market. And even high yield bonds ended up making a little bit of money. We'll talk a little bit more about what's been going on with yields. Have they been coming down? And some of the developments that might come from that going forward. And lastly, the commodities. This is a little skewed. It shows negative 7.94%. A lot of that was oil and some of the industrial metals. Gold actually had a really good month, up about 4% or so, which is more of the exposure that we have in that commodity space. So overall, it was a pretty flat month, and the diversification helped keep everything afloat. But a pretty exciting month, but pretty flat month overall. And a quick market update here for January. Things started off with a bang. We had the phase one deal done, Brexit in the books. The Fed had been pumping liquidity into the markets by buying T-bills to shore up the money markets. And all that basically meant that the market was super happy. Things started off really, really well. And then, of course, the coronavirus shows up, the party pooper, right? And so right towards the end of the month, there was a big turnaround with the scare with the coronavirus. It seems to be pretty contagious. And it unfortunately came at a very bad time in China during their lunar holiday. It's like a new year over in China. And they do a lot of travel, a lot of spending. And normally it wouldn't be that big of a deal, but China is now a huge part of global growth, about 16%. And so whenever they slow down, the fear is the world is going to slow down globally. So what effects are going to have on the global economies, we shall see. But that is definitely a concern that continues to this moment. As you can see, the leading indicators have been getting a lot better. And so this is a good sign. This is most likely why the market had been leading up and doing so well in the last quarter. They were anticipating things getting much better, and the numbers are starting to show that, and we'll show you a little bit more in the latter slides. Valuations and sentiment still elevated. I would say the valuations more than the sentiment now. The sentiment was super high last month, but it has gotten a little bit more mellow, let's say. And a lot of that has to do with some of the concerns with the coronavirus. But valuations still seem pretty high. We're still about where we were in January. And so I'm still a little bit concerned about that. But the earnings that have been coming out have been strong. So maybe that will be enough. We'll see. And lastly, the bonds. Bonds have done very well. Yields have actually gone down, which means the prices went up. And when does that happen? When there's fear. And so whenever there's fear, like in this case, the coronavirus, that's made those yields go down. And when yields get this low, I start getting a little nervous about bonds. And so I'll show you some of the ideas that I'm doing with the fixed income to hedge that risk. So that's that's a wrap up for January. Thanks. Okay, let's talk a little bit more about the coronavirus. This is obviously the biggest issue that's been bringing the volatility and uncertainty to the markets in the last about month now. And so you can see from this chart, which I got from the World Health Organization, that the coronavirus has a lot more cases than what we've seen with SARS or MERS, which is used as a similar type virus that spread rapidly in China. So as we can see here, it's a lot more contagious. So the bad news is it seems like a lot more people are getting this. In fact, just this morning I heard it was up to like 31,000 plus. But the good news is, I mean, the deaths are never good, right? But the mortality rate is much lower as a percentage of the cases. So it seems like, maybe more people are getting sick, but fortunately not as many fatalities from this. Hard to know if it's just the virus isn't as lethal or if technology and medical care has improved. Maybe it's a little bit of both. But the point for bringing up this chart is to show you that it's very serious, but maybe not quite as scary as sometimes the newspaper headlines and the news media like it to be. Now, this is the slide that I want to show you to make my main point about this coronavirus problem. As you can see by this chart, historically speaking, the market has pretty much always gotten over these epidemic scares. These are examples of AIDS, pneumonic plague, SARS, Asian flu, dengue fever, swine flu, so on and so forth. And pretty much in every situation, the market has done pretty good. In fact, here it shows you what happened after 1 month, and after 3 months, and after 6 months. And pretty much all situations, they ended up positive. Now, SARS is the one that's being used as the closest parallel to what's going on with coronavirus. And a lot of people like to say how things went up after SARS. But what you can see from this chart is the market was already kind of down. And SARS probably had very little to do with it. The market kind of bounced after that. Now we're at a much higher point at the market cycle. And maybe there's more cases, so it could be a little bit worse and have a bigger impact. So I don't want to say that this coronavirus could be something that is going to be positive by any means, like some are sometimes pointing out with the SARS parallel. But I still see the trend as these viruses, usually they get contained, a vaccine is introduced, and things start settling down. And I think this is probably what's going to happen here as well. The key question is, how long is it going to go for? The longer it goes, the more impact it's going to have on the Chinese economy, thus the global economy. That's a hard thing to guess. So it definitely is making me a little bit more hesitant on getting too much more aggressive and really sticking to more of the neutral stance that we've had over the last few months. Okay, and for the outlook, unfortunately, volatility will continue. As long as the coronavirus is out there and there's a lot of unknowns about how much it's spreading, we don't really know exactly how many cases there are. We're just kind of taking China's word for it, which hopefully is correct, but we still don't always really know with them. So it could be worse than we realize. And until it's contained and there's a vaccine and there's an action plan and we see the cases start to settle down, there will be continued uncertainty and possibly even a correction from this if something doesn't at least change in a more positive direction soon. Also, we have the issue of more extreme government policy proposals. For those of you that have been watching some of the Democratic debates, there are some that are more moderate and some that are a little bit more progressive. And so the market has been getting a little bit anxious with some of the policy proposals from the extreme left of the party. And it seems like, for example, Bernie Sanders has been doing pretty well in the polls, recently did pretty well in Iowa. So as long as that potential is out there, that uncertainty and volatility will also continue throughout the primary season. So another potential headwind for this market that appeared to be really getting ready to rock and roll. Now, on the flip side, if we do get some containment of the coronavirus, right now could be a pretty good buying opportunity because we have fundamentals starting to improve. Maybe the coronavirus is only a short-term blip. Hard to know, but if it is, there could be some monumental buying opportunities for the year because the current administration is going to want to have everything go smooth this year. That usually helps incumbents get reelected. So we can assume that trade wars and things are probably going to be on the down low this year. So these are all going to be good things for the economy. And so, again, this could be an opportunity. So what are we to do? I'm still going to keep the neutral stance. I would like to get a little bit more aggressive, but some of the risks that are still out there are making me a little hesitant. The changes that we'll make will be more little fine-tuning tweaks on the fixed income, a little bit on the equities, but not really changing the asset allocation from that neutral stance. All right. Okay, I always like to leave you with an educational tidbit. And the one I'd like to highlight today is what's called the health savings account. Now, a lot of people know of the health savings account as an account that you put money in and you can use for your medical expenses. The idea that I want to float out there today is that it could actually be for your retirement. That's why I have a question mark there, because it's a little unorthodox. Real quick basics. The health savings account has what we call the triple tax favored treatment. When you make your deposit, it goes in with a tax deduction. It grows tax deferred. And then when you withdraw the money, as long as it's for qualified medical expenses, it comes out tax free. So it's really the trifecta. And the typical use is you put the money in, you have a medical expense, you take the money out. So the idea that I wanted to float out there is, why not leave the money in? If you can afford to pay for your medical expenses out of pocket, leave the money in the HSA, okay, the health savings account. Let the money accumulate. The money is always yours. It's not like one of those flexible spending accounts that if you don't use it, you lose it. The money's always yours. You can actually invest it. There's lots of different accounts that even allow you to buy mutual funds and things like that, so it can grow. And then later in life, you could use it, like in retirement, to pay for medical expenses, like long-term care and different healthcare expenses that you have in retirement. Also, it could be used to pay for Medicare Part B and Part D, which is the drug costs. So it could be another retirement vehicle, especially for those that can afford to actually take care of the medical expenses today. And I can make the argument that it's probably the best account out there because it has, again, that triple tax favored treatment. Something to think about. Okay, I always love to leave you with a little inspiration. And I just love this quote from Randy Alcorn. It's generosity is just as contagious as materialism. However, it brings life instead of death. And I found this picture of this little girl with her hand out, giving some grain. And it just made me think of how when we are generous, we open up our hands to give. And when we open up our hands to give, we also give the opportunity to receive. And I think that's what he meant by this quote. And it's not about, the more I give, the more successful I'm going to be. And it's like, a recipe. But we should give because we want to give. It should be just something that we give from the heart, out of love for the people that we're with, and it's the example that Jesus gave to us as well. So we should do as he did. And I'll leave you with this quote from the Bible. "Give and it will be given to you," Jesus said. "A good measure pressed down, shaken together, and running over will be poured into your lap." In other words, you can see as you give, the more that you will get. Isn't that awesome? Thanks, guys. Thanks for tuning in, and we'll see you again next month. Okay, we're going to get a little bit more into the details. That's why you're still watching. I'm going to go through a few slides starting with the leading indicators. Now, this leading indicators chart goes through January 31st, as you can see here. So we're about a week behind with this one. But you can see how the red dot is still kind of in the declining quadrant, but really close to the expansion quadrant. And what we don't see is the recent figures that have come out from, for example, manufacturing. Manufacturing is in the declining quadrant, and as of the latest report, it's actually been moved slightly into the expansion quadrant. And we've also had some good numbers, really just as of today, from employment. The employment numbers, job openings and hires, all that has been moving to the right. And so I think when the newer version of this chart comes out, it's even going to be a little closer to the expansion quadrant. All very good signs showing the economy is healthy and actually has been getting a little bit better. Okay, and you know how I like to do the math of the market update. This is a little spreadsheet that I have that shows us where we are on the valuations. So again, showing you the estimates for now and the estimates in the near future, the next 12 months, we're showing about a 6.5% earnings per share growth, just based on a couple sources that I use, and I average them out. So that would mean that we would have the S&P over the next year go to 3252. But as you can see, as of about 2 o'clock today, which is the 7th, the S&P is at about 33 and change. So when you add the dividend, you're still at a small negative return for the year, which means that the market is pretty pricey right now. So again, we could have earnings a little bit better than what some of these sources are saying. Let's say it gets into the 185 range. Which there are some analysts that are thinking it could get into that range. That would be double-digit earnings growth, and that would mean about a 5% or so from here potential in the S&P 500. So you can see how I think that the valuations are slightly high. I think there are more opportunities in other parts of the market, which is why I've been talking about the international and particular emerging markets. Unfortunately, the coronavirus has made a serious dent into that thesis, but again, it could be a pretty good buying opportunity if things turn around. But as you can see here in the U.S., things are a little pricey. They're strong, but they are a little pricey, so there's limited upside there. Okay, so it's political season, so I wanted to show you a slide that talks a little bit about that, and I apologize ahead of time if this information is slightly controversial, but I just want to show you the facts. So some may wonder, well, why is Bernie Sanders doing so well and some of the socialism becoming more popular than maybe it has in the past? And I don't know if I can answer that very well, but part of the reason might be that, as you can see from this chart, a share of national net worth by percentile groups, the top 1% are gaining more and more of a percentage of the national net worth versus the bottom 90% going down. So, you get this inequality that becomes a little bit more prevalent, income disparity, and of course, that's going to get people rattled, and they're going to want to come up with ways to solve it. That might be good, that might be bad, but this is essentially, I think, why you're starting to see these voices become a little louder, which is, as you saw in my outlook, one of my concerns during this primary season, that these voices not only are becoming louder, but they're winning on the Democratic side. So I think it's just going to be another piece of uncertainty that we're going to have to deal with this year. And here's our last slide. I've been talking about how the yields have been coming down. This is the 10-year Treasury yield. And as you can see, it's been steadily coming down. And recently, it was up a little higher in December, and it came down again with the coronavirus concerns. We've seen a small little blip here, but still overall pretty low. When you have a 10-year Treasury that is paying about 1.5, 1.6%, that's essentially what money markets are paying right now. So it does create a little bit of a predicament. I don't want to put all your money in stocks, so the other alternative is having some fixed income exposure. But when fixed income is paying so little, it does cause pause. And so what you'll probably see me doing is using a little bit more in cash, where I take less risk, get similar yield, or just come up with different alternatives to bonds. We've used the Gateway Fund, convertible securities, high yield, preferreds, different alternatives to just good old-fashioned treasuries and high-grade corporate bonds, just to hedge the risk of rates going back up. They may not go back up anytime soon, and so I'll still keep some exposure, because if this coronavirus continues, interest rates may stay low and go even lower, and who knows, the Fed might even lower rates again, and there is a good probability for that to happen. But my base case scenario is I believe rates will stabilize and maybe even go back up to the 2% range. And if they do go back up to the 2% range, that means bonds, the aggregate bond market will probably lose a little bit of value. And with yields so low, as you see here, any loss of value could be a wash to total return, or maybe even a slight negative. So this is an area that I'm closely monitoring, underweighted in the aggregate bond type portfolio. That's why when you look at your fixed income, it's got a lot of different components in it, because I'm trying to hedge a little bit of all those risks that I mentioned. Thanks a lot for listening, and that is it for this month's presentation, and I hope to see you guys next month.